Today's analysis is all about the US dollar. We're going to talk about why I think the US dollar has more upside. I'll make a case as to why I think so, but maybe just as importantly, what this means for several other markets. What does this do to the stock market, to the precious metals market, and to the currency market? Let's explore that in today's video. All I ask as we get started is if you could do me a favor, hit the thumbs up button, subscribe if you're new, let's get into it. So first and foremost, let's just talk a little bit about the technical analysis behind the US dollar. I found this Reddit post that says the US dollar is on track for its worst year in modern history. It's been pretty much a straight shot to the downside since everything that took place with the tariff concerns and just a general trend away from the US dollar amidst a lot of kind of up in arms nature of this whole global trade war stuff. But it's not just about the trade wars, it's also about the rate cuts. We're expecting rate cuts through the end of 2025 and into 2026. So with rate cuts expected, we do see the US dollar losing a little bit of its strength. In recent years, we've also seen the consumer price index fall for the US, which has been a supportive story for cutting interest rates. Remember that the Federal Reserve hiked interest rates to try and put a stop to inflation in the first part. Now that we actually see that inflation coming down, for the most part, I mean, it's much better than where it was, we are now seeing rising cases to be made for cutting interest rates. But all of that, the rate cut idea and the de-dollarization due to tariff stuff is largely behind us. That's sort of old news. So as traders, we can't make money looking in the rearview mirror. We have to look in the windshield. And when we look ahead, I actually think that the US dollar may be in a period of consolidation or potentially even on the brink of a rise or an upward trend and a breakout to the upside. From a technical perspective, like I said, we've had a really bad year for the US dollar, but the momentum has certainly slowed for dollar bears, and we've now actually seen a sideways consolidation phase. When we zoom into the daily chart, yes, we have a pretty clear downward path, but we've seen something interesting. We've come back up to the upper end of this downward channel, and we are now testing a pretty key level of resistance. But now we see some of the same stories that were dollar bear allies turning into dollar bear enemies or dollar bull friends. What I mean by that is inflation is now on the rise again, and rising inflation could put a pause to interest rate cuts from the Federal Reserve. While we are still expected to get a cut in October and a cut in potentially in the end of the year, December, there's still a possibility that we cut a few more times and then we go on pause again, which could support a stronger US dollar. And one of the reasons for that is sticky inflation still being a problem for the Fed. Remember, the Fed wants to cut rates when the US inflation story improves. But if it is in the process of bottoming out and they cut interest rates, there's a potential that they actually extrapolate and make worse the problem. So from a technical perspective, I would watch really close what happens around this 98.75 level. We're coming very close to a pretty key level of resistance. And if this level breaks out, it has the potential to continue up towards 100, which in my opinion is a reasonable target to kind of look forward to when it comes to the US dollar. We'll see if I'm correct, but let's also now take a look at some of the growth metrics that in my opinion support a stronger US dollar. I've navigated to the US economic heat map within the software that I'm using, the Edge Finder, and what we can see here is we have some interesting statistics to look through. GDP growth, for example, has come in much higher than expected. We surprised by a large margin, showing that Q2 was actually a very strong period of growth for the US economy on a overall gross domestic product output. Manufacturing PMI also beat expectations. Even though still in contraction territory below 50, it was still better than expected. Services PMIs was a bit of a miss, but then retail sales were strong. We've already discussed inflation, which remains sticky above the 2% target and rising. And unemployment rate is still pretty strong in the US at 4.3%. This is historically a pretty low reading, with long-term averages being around 5.7 to 5.8% unemployment in the United States. Though the jobs numbers that we did get last week were not great. The ADP numbers came in much lower than expected, and we still have a very big question mark in terms of the NFP report, which, depending on what happens with the government shutdown, may be pushed back once more this week. We are expecting to get it on Friday, though if the government shutdown persists, it will get delayed again. We also see something geopolitically happening that is very positive for the dollar. We did see a prime minister take place in Japan, first female prime minister, and she is expected expected to be quite dovish for the Japanese yen. And remember that currencies are all relative. So if you get a weak Japanese yen, that does make the dollar look proportionally stronger. By the way, the tools that I'm using to do this analysis are actually going to be up for grabs completely free because we are doing a giveaway this week. Let me tell you about that. How would you like to win a free copy of the Edge Finder? Well, this month we are giving away not one, not two, but 3 free copies of the Edge Finder to 3 lucky winners. That means if you join, there's a 3 times chance that you are going to be the winner of a free copy of the Edge Finder, which is usually a $1,400 product. With the tools offered by Edge Finder, you can track institutional positioning through the commitment of traders data or the put to call ratio to study what crowd sentiment is currently like on your favorite charts and assets. Or if you're interested in tracking macroeconomic data and how it could potentially impact things like gold, silver, commodities, currencies, and indices, check out our US economic heat map. This table allows you to see all of the major economic readings that things like the Federal Reserve are watching to set monetary policy, and these things drive trends dramatically. Or check out our economic surprise meter, which shows which currencies are stronger than others based on the economic data being released. And you can tie it all up with the top setups page that we offer within the Edge Finder, which scans all of this data and generates bullish and bearish readings for your favorite symbols. So now that you know how awesome the Edge Finder is and that we're giving some away for free, how do you join? Step 1 is to join our Telegram channel. We'll drop a link down below, or if you scan the QR code that you see on your screen right now, that'll take you over to the Telegram channel. That's step 1, pretty easy. Step 2 is to make sure you enter the giveaway using the form being shared in the Telegram channel. Simply fill out this form, takes about 1 minute, and your name is in the hat for a chance to win. And there is no step 3. Step 3 is, I guess, simply just wait to see if you're the winner. There's no harm in joining, so best of luck to you, and remember, 3 people will be winning, so make sure to throw your name in for a chance to win. Just to recap, step 1, join the Telegram. Step 2, drop your name in the form that can be found in the Telegram, and you're good to go. Now let's get back to trading. So now back to the technicals. I'm watching really close this 98.70 level to see if we can actually poke and stay above this area. If this does take place, I think there's a good chance that we continue to see rise in the US dollar. Though personally, I went long right around the 97.80 level on ticker symbol UUP. UUP is a dollar index bullish fund that I can trade in my stock brokerage account. I'm up currently on this one nicely. I have 5,000 shares, and I do think that there is more upside for the dollar. So I am still in the position. And again, this one basically tracks the same thing as DXY. So I'm looking for further upside, and I do think that we'll get it, depending on what happens with the NFP data, which could take away from this story. But for now, I think a path of least resistance for the dollar is a move higher. So now that we've talked about all of that, what does this do to the rest of the market? For those who watch precious metals and currencies and indices, what's next? Well, believe it or not, precious metals do not have to fall on a stronger dollar, though most of the time they do. So I actually think that it is very potentially viable for the precious metals, which have been in a straight up move, to have some sort of healthy corrective pullback, but I don't think they have to. They could continue to move higher, and currently I have a neutral bias when it comes to gold and silver. Though looking strictly at the macro, I don't love the story for gold and silver due to the strong growth metrics that we just got done discussing, and the reason I think the dollar could go up could also negatively impact the gold and silver market. Also taking a look at gold and silver, it's not just macro that we look at in terms of scoring it within the Edge Finder. We also have things like the commitment of traders data, which has been really bullish for things like silver, retail positioning. Seasonally, it's still a good period of the year for gold and silver. So there's some forces at play where I just don't want to be short or fighting the moves that are taking place. Momentum still clearly favors the bulls. And so again, I think there is the possibility that you get gold, silver, and the dollar all moving higher at the same time. And let me explain further what I mean by the dollar and gold are not exactly inversely correlated. Over large stretches of time, typically a stronger dollar is not great for gold. But there are also times when we take a look at the correlation coefficient, which is what I have here drawn below. If I take a look at this indicator, if I pull open the settings, what you can see here is I've selected DXY and I've compared it to gold spot, which we've got pulled up. What we see here is that when you have a very low reading, it means that there is a strong inverse correlation, meaning dollar up, gold down, gold up. And when it goes the opposite direction, it means that they're moving in combination. So gold up, dollar up. And so what you can see is that it's not a perfect relationship. They go back and forth. And so there's not this solid example of, gold and silver are always inversely correlated. Though when we kind of zoom out, you can see generally speaking, a stronger dollar is not great for gold and a weaker dollar is great in gold for gold and silver. But doesn't mean that every single day the correlation is perfect. Or I should say the inverse correlation is perfect, as typically, but not all the time, gold and silver does move inversely to the dollar. I hope this is making sense. I know it's a little bit complicated if you're newer to correlations, but just understand that gold and silver and the dollar do not have to move opposite and can, for a long period of time, move together if they want to. That being said, most of the time, slight preference would be a stronger dollar is not great for gold and silver. So that's where I see limited upside personally for gold, but definitely not enough conviction to short or fight this rally. Same thing with silver. This thing's been a rocket ship, and congrats to any metals bulls. This has been such a winning period for anybody who has held these, and as a longer term holder and a trader of gold and silver, I'm just thrilled to see these kinds of moves taking place, as for the metals crowd, this has been something we've been looking forward to for a long time, and it's kind of vindicating to say the least. So now moving on to indices. What does a stronger dollar usually mean for stocks? Well, again, it's not a perfect correlation or inverse correlation, but a lot of times a stronger dollar can lead to a little bit of softness in the US stock market, especially if it means less rate cuts. That could potentially take away from what has been a really solid rally off the idea that AI is never-ending CapEx spending, meaning more money flooding into the system. And the other big stimulus event would be rate cuts are also stimulating to the economy, or to the stock market and to the economy. But the stock market is pumped up on the idea of stimulus. That's why I think you've had very little pullbacks. And so if there is a little bit of a reality check with a stronger dollar or less probabilities for rate cuts coming, let's say you get a strong jobs print, I do think it actually could lead to a period where the stock market trades sideways or pulls back. In which case, the bigger picture for me, I'm still a bull on these things as well, but just waiting patiently for dips. The stock market has been a monster this year, with the rebound in April looking really strong. There's one more force at play with the stock market, and here is a very strong reason for why I am not interested in taking some kind of giant short on the stock market. Let me show you. What you're looking at is the full year seasonality for the S&P 500. The red line is the year-to-date performance of the S&P 500. Clearly the big drop in April with the very strong recovery since. Now, if we actually zoom in here and just hover over this section, what we can see here is that seasonality has an expectation here for the rest of the year to see a continued rally in stock prices. This is very often called the Santa Claus rally or the fourth quarter rally or end of year rally, whatever you want to call it. Typically, there is a rally in the stock market, though not all the time, and this is not a perfect predictor by any means. Typically, we do see some solid, strong price action for stocks towards the end of the year. So while I do prefer to wait for dips and pullbacks, I fully recognize we may not get them. You may just get the rally into year's end, and I do own some stocks. I'll show you really quick just a collection of stocks that I own in my portfolio. I'm long Amazon, Meta, Uber, NextEra Energy, Xcel Energy, Biogen, my dollar position, and I have some money sitting in SGOV, which is just a 3-month treasury yield thing as well. And today's video is sponsored by Vantage Markets. If you're someone trading outside of the United States looking for a better CFD brokerage to trade with, check out Vantage down below in the description. They're currently offering a generous welcome bonus to my subscribers. They have low trading fees, and you can trade CFDs on pretty much anything. Anything from stock market indices to individual stock CFDs to forex to cryptocurrencies. Explore the full list of products that they offer and take advantage of that welcome bonus down below in the description with the link shared for my subscribers. Thanks to Vantage for sponsoring today's video. Now back to it. Does it happen every year? No. In 2018, I remember there was a massive sell-off right around November, Thanksgiving into Christmas. It was just a straight drop. So could you get that? Sure. Again, history is a guide, but it's not a guarantee. So if we go back and just look at 2018 during this time, and I was trading during this time, it was a wild move. Look at this. So right around October, stock market was looking so strong. Like you had just this up year. You know, there was worries in the beginning of the year, and then you just had pretty much a grind higher. You had dips in between, which to be honest, I would have much preferred a 2018 type of dips having been presented to us. We haven't really had a lot of dips, but you can't complain about it. It doesn't matter what has happened. You have to look ahead. Well, you had this straight up move that ultimately turned into a straight down move. We had a sharp plummet into year's end. So just because you have seasonality on our side doesn't guarantee that the market will go up. So please understand, why do I show this example after just making the point that I think stocks will likely go up into year's end? Because you have to like kind of pump the brakes on somebody who's brand new to this stuff, who hears, oh, stocks should go up in November and December if we're looking at history, and then goes and leverages their whole portfolio, and then you get a 2018 move and it blows them up. Don't be that guy. Don't be that girl. Stay away from leverage. Just, in my opinion, no need for leverage. It's just it's a dangerous game to play, because you get something like this can wipe you out. So I'm just showing you that as a reference point. So US stocks, they look invincible right now. They could pull back. And I think personally, it's a dip to buy, in my opinion, not financial advice.